Hi, and welcome to our lesson. This is our last lesson on the risk management process. In this lesson, we'll take a high-level view to help understand the risk management cycle. We'll also discuss the risk attitude, how management's risk attitude can significantly affect a firm's willingness to engage in certain activities. The risk management process is an iterative process. Firms should engage this over and over again. The process can be broken down like this. Firms need to identify the risk, analyze the risk, evaluate the risk, manage it, and then monitor it. Let's think through an example. A firm might identify that there's a potential lawsuit against the firm. The firm will then analyze it. Why is this lawsuit potentially happening? Who would be filing this lawsuit? Really understand the issues surrounding why this lawsuit might come to pass. The firm will then evaluate. What is the likelihood that this lawsuit will take place? And if the lawsuit does happen, what are the possible outcomes? How will it affect us as a firm? The firm will then choose to manage the risk. Should the firm take action now to prevent the lawsuit from happening? Should the firm get insurance in case the lawsuit does happen? Or should the firm just let the business operations continue and see what happens? The firm will have to make a choice. This is a cost-benefit analysis the firm will have to make. Finally, the firm will want to monitor and keep track. Is that lawsuit been filed? Should we keep track of it? Is something else developed and changed? You can see that this is an iterative process. It should be done in the short term and long term in case there's other factors that affect the risk profiles. Next, let's discuss risk attitude. Risk attitude is generally set as a tone at the top. This comes from the firm's management team and the firm's board of directors. A firm's risk attitude, are they risk-seeking? Are they risk-adverse? Will affect which activities the firm chooses to engage in. This can sometimes lead to higher rewards. High-risk projects often have high rewards. However, they also have that higher risk of failure. Again, this is the cost-benefit analysis. We've used several techniques, qualitative methods, quantitative methods, that you can use to evaluate, is the higher risk appropriate or is the higher risk too much of a risk of a failure? The effective manager will be able to identify which risks the firm should assume, which projects they should undertake, and which ones they should avoid. In this lesson, we've talked about the risk management cycle. It is an iterative process that firms should engage in. Importantly, it's set as a risk attitude as a tone at the top of the firm. Your firm should actively engage in risk management. This will help the firm to be most effective and to increase their firm value.